gain to get back to even. This is arithmetic. Some people call it geometry. So you could argue SVB's nearly 40% rally this year is barely a drop in the bucket. And that's how I want you to think it. I think it's also a good example of why these bounce back moves might be far from over. These stocks could have more room to run, especially if you think they were driven down to artificially low levels.
On December 31st, 2022, Silicon Valley Bank was ranked the 16th biggest commercial bank in the US. As of last Friday, it no longer exists. For this week's video, I'm going to dive deep into what happened to SVB that led to its collapse, what does it mean for the rest of the financial system, and why is this a pivotal moment for the future rate hikes. Now, a large amount of info here is based on a blog that I am subscribed to called Aprecidas Economics that is written by Joseph Politano, who is an independent economics writer. In my opinion, he's one of the best writers when it comes to US economy. So if you're interested to get more of these kind of info, I highly encourage you to be a paid subscriber on his website. And before we start, as always, help us like this video and also join our free private Facebook group for more content and ask questions in there as well. Alright, with that said, let's dive into the collapse of SVB. First, let's talk about what happened last week. On March 8, 2023, another bank called Silvergate, which is a smaller bank specializing in crypto business, announced that it would voluntarily be liquidating due to a massive loss, rapid customer withdrawals, a Department of Justice probe, and a worsening crypto market. Same day, Silicon Valley Bank SVB announced it sold a great amount of US Treasuries and agency mortgage-backed securities at $1.8 billion loss and would be raising more than $2.25 billion in capital to strengthen its balance sheet. Hearing that, which is a signal for SVB financial health not in a great shape, March 9th, customers rushed to the bank to make large amount of withdrawals. In total, there was a bank run of about $42.5 billion in one day. Because of that, SVB couldn't even make it to the weekend. By Friday morning, March 10th, California and federal regulators shut down the bank, citing illiquidity and insolvency. SVB's collapse would mark the second biggest banking failure in American history, just after 2008 Lehman Brothers collapse. The Federal Deposit Insurance Corp FDIC, which is similar to our CDIC in Canada, have placed SVB into receivership. Now, originally last week, what led to a massive drop in the market and especially bank stocks was what about the uninsured depositor? Because SVB's clients are very unique. Most of their clientele are actually startups or VCs or high net worth individuals which have well over $250K insured amount deposited inside the bank. It was estimated that only 6% of SVB's clientele is under the $250K mark. And this brings worry and fear to the market, wondering what happened to everyone that's over $250K mark. Would they get those money returned to them, or they would just take a massive loss? Now, at the time that I'm recording this, the US Fed have stepped up and said that all people that is over the $250K mark that is not supposed to be insured by FDIC will also get fully insured and covered. They will be made whole and will not lose any money on their deposit. Now, this is a very important step and a point that I will be addressing at the end of this video, why this is very necessary. But first, let's talk about SVB's collapse. As we have said, SVB has a very unique clientele of high net worth individual, VC, or startups. They've always had a low share of insured deposits since its focus on the wealthiest industry. And during the pandemic time when interest rates were cut, VCs and startups were the industry that saw the biggest boom. SVB has received quadruple amount of the deposits at peak level versus their early 2018 level. This led their insurance deposit amount went from already low 9% to an even lower amount of 4% overall. More than 37,000 accounts with SVB exceeded the FDIC $250K insurance level. Average client's deposit size were around $4.2 million. Now, as their money power grew during a low rate environment in pandemic, SVB, in order to squeeze more profit for themselves in the long run, decided to take a very aggressive stance and go heavy into long-term US Treasury bonds. By late 2021, more than 55% of SVB's assets are in long-term asset that is maturing in 5 years or more, up from 35% before pandemic. Basically, they have bet on the long-term direction of interest rate and it did not pay out for them. So for people that are unaware why this is such a huge issue, imagine if you're trading GIC right now. Let's say you have bought a massive amount of 5-year GIC at 2% during the pandemic. And last year, interest rate have rose all the way to 5%. So every single person that is doing a GIC right now will be getting 4.5 to 5% up there. You, with the 2% GIC for 5 years, do not want this and you want to get rid of it and maybe get a 5%. But the question would be, who would want to buy your 2% GIC when everybody can get a 5%? The answer is no one, unless you give them a massive discount. And this is why bond prices have opposite movement versus interest rate directions. And this kind of opposite price movement is more extreme the longer the duration is for the bond, because you're potentially locked into a much lower or much higher return versus the interest rate right now. And because of SVB's aggressive movement into the bond market for long duration bonds, combined with the fact interest rate went up 5 times versus the beginning of the year, these long duration bonds swung violently in terms of the price. And we combine this with the fact that the whole tech sector is not doing well, which is the main clientele of SVB. That means VCs and startups now have to withdraw at an accelerated rate because they are also probably not doing well. So what do SVB have to do when there's massive withdrawal? They will be forced to have to sell the current bond portfolio at a massive loss to come up with the money to give back to their clients. Now, as of last Friday, the bonds that SVB have sold had a yield of 1.79% and a 3.6 years duration. Now, just for comparison, a 2-year treasury in the US at that time is paying 5% already. So nobody would want the 1.79% for 3.6 years unless you give them a huge, massive discount. So you can see why this is such a big problem and a vicious cycle. The more people that will withdraw from SVB, the more they will have to sell at a massive loss for their long-term bonds. And eventually, they will realize they are going to run out of money. They don't have enough to cover all the people that deposit money with them unless they're able to raise a massive amount of capital in a short time. Now, just to go a little bit deeper into this, before this collapse, when they realized such pattern is happening, last year, what they decided to do is categorize all the bonds into different durations. So maybe 3 year, 5 years, 6 year, 10 years, etc. And then mark most of them to held to maturity instead of available for sale. Basically, what they're doing is they are going to hold most of these long-term bonds until maturity. Because when they hit maturity, all that fluctuation I've just told you about GIC price going up and down and opposite to interest rate, they don't matter anymore. Once you hit maturity, just like a GIC, the principal will be returned to you plus whatever interest you have gained during those times. So their theory is that with long enough time, their losses do not matter anymore because by maturity date, they will be able to recoup all their money back. And this also allows them to not have to mark these kind of bond at a massive loss onto the market available for sale, which means it would have been readily able to sell and get the cash back, but they would have to put it on the market and people will see these kind of losses. So as interest rate increase massively, they have suffered a great amount of losses. Accumulated Other Comprehensive Income AOCI, which only looks at unrealized gain and loss of available for sale bonds, so not even the ones that are held to maturity, just the small amount that they have put on the market, sunk to more than negative $2 billion at its peak. If we were to include all those held to maturity bonds that they're not putting on the market and just holding them, the estimated loss is up to $15 billion. And this problem will only get worse as interest rate increase, which looking at last month's inflation report in the US suggests that we are going in that direction. Now again, with long enough time, SVB could have survived this, but the time is not something they have on their side. SVB basically have dug themselves into a hole and created 2 issues. They're facing a short-term liquidity issue while having a long-term insolvency issue. By end of 2022, more than 25% of the bank's security portfolio was already pledged as collateral to secure short-term loan, and they would maybe have to pledge even more for the next coming months. And on top of that, SVB was also borrowing a massive amount of loans from the Federal Home Loan Bank FHLB, which is a government-sponsored member-owned bank that offers liquidity through security loan. SVB alone account for 20% of FHLB San Francisco's loan outstanding. Now, banks usually do not tap into these kind of security loans unless they absolutely have to. So the fact that they're borrowing 20% of all available borrowing out there from the government suggests how much stress they were under. And this has led to what happened last Friday. Government have stepped in and shut down SVB. So let's talk about what is going to happen next. Now, since 2028, the great financial crisis, uninsured depositors were only able to get back 50 cents on the dollar during those times. Now, since then, it has been an official US policy that all depositors will be made whole by the US government coming out with a plan to cover any amount that is over the 250K insured mark. They're going to be doing this either by selling their entire bank to someone else, selling them off as a piecemeal to different banks, or using other means necessary. And this is the thing I do want to address, because a lot of people online were saying, why are we helping these people that are, VCs or high net worth that have over 250K mark and they decided to put everything into one bank? Well, the problem is that even the most sophisticated clients cannot easily assess a bank's financial health, and it's not really their fault to decide to put deposit into a bank that seemingly is pretty secure. 16th largest commercial bank in US. Is not a small bank. It's not a no-name bank. They have been around for a long time. They've been doing well on paper. So you can't really blame those people to put all the deposit into one place. And also a lot of these, like we said, are VC startup. They're companies that have payrolls that need to use this money. And their amount are going to be up to millions of dollars. You're not going to expect a company to open 20 or 30 accounts with different banks just to hit those 250K insured amount. It just doesn't make sense from an operation perspective. So of course, they will be placing most of their money with one or two banks. And also you have to think about this. If these people that are over 250K mark do not get government intervention and do not be made whole and they actually suffer losses, what is going to happen Monday, which is right now as we're recording? Every single person that has more than 250K with any banks in US are going to make withdrawal until their amount hits 250K, and they might go into other bank and deposit there, or they might just have the money in their home because it's no longer secure because they know government is not going to help them. If that's going to happen, you're going to see bank run across US, and all smaller regional banks are going to get hit with the same problem, because I can tell you that every single bank have took massive unrealized losses on their bonds because of interest rate hike. So this is going to hit everyone. So you're going to get a chain collapse of banks across US, and we're going to have another 08 right now. So this is why theoretically those people over 250K should not be covered. They have to by the government in this case to prevent a total collapse in the banking system. Now, usually the most common way is for a big bank to step in and just buy SVB outright, buy all the deposit, buy all the client list. The fact that they have a better relationship with all these VCs and startups may make them more enticing to be bought as an asset versus other banks. However, as of right now, no one has stepped up to buy SVB as a whole. Maybe every single bank are assessing their own situation, and they're basically scared to be the bag holder or become the next SVB by committing too much. FDIC on Sunday have acted very quickly and have established a $25 billion fund to ensure that every single person would be able to get their deposit 100% back. And this is a great news because this issue is not just unique to the US with US clientele. I have known a couple public companies, they also bank with SVB on their payroll. So if FDIC do not act fast like they just did, a lot of people, even in Canada, would be unable to receive their paycheck come next week, which is going to lead to a massive problem in the economy. Now, also SVB do hold mostly high quality US Treasury as assets, so this makes them a little bit easier to kind of get sold or get managed, I'm guessing, versus other banks who have bought like junk bonds, etc. And because of this, SVB bonds, as the time I'm recording, are still trading at 30 to 40 cents to a dollar, suggesting that investors and bondholders are still hopeful they're able to get some money when the whole process is done. But obviously the situation is extremely volatile and there's still a lot of unknown going forward. Alright, so let's talk about, is this contagious? Is this going to lead to a chain collapse in the US economy or even affect Canada? Obviously nobody knows for sure, but right now it seems like the answer is no. One thing that is very different from 08 for SVB's situation is the credit risk, which means clients' ability to pay back their loan. As of right now, charge-off and past due rates for loan remain at a very low rate despite it has ticked up slightly. So conclusion is that no substantial defaults on banks' asset. But another risk to consider is the duration risk. What SVB did, which is very aggressively buy into long-term treasury bonds during pandemic times, is not unique just to SVB. Other banks may not be so aggressive, but they still have significant mark-to-market losses and have been increasing their long-term securities for many years. This is why how regulators handle SVB is very, very important and is a very delicate situation. If they did not act as quick as they did during the weekend and make every depositor whole, but no bailouts for the shareholders, just the depositor, they would make everyone lose confidence in the banking system and will lead to a massive chain collapse. And this collapse, maybe even worse in 2008 if they didn't act quickly. So I'm very glad they did what they did, and they decided not to bail out the bank for their poor decision as well, the shareholders. So that's a good thing. Now, one thing I do also want to make clear is that a lot of people online have been citing that, hey, these executives have sold shares right before the collapse. Some have sold like 10 to anywhere from 20%. And also, employees have all gotten bonuses upward to like 100K or something. This is scummy, this is premeditated. I want to make clear of this misconception. The executives usually, when they have to sell their shares, have been prearranged a date years in advance. This is to avoid insider trading. So no matter what is going on with the stock price, they will be selling the same amount of shares regardless as the part of their compensation. Now for employees, I've looked at their bonus payment schedule. Every year for SVB, the bonus pay out in March. So this is just a coincidence that this happened right before the collapse. It's not an unethical or scummy thing that they did on purpose, other than the fact that management have made poor decisions to buy long-term bonds and unhedged and led to their collapse. I want to make that clear because I do not want any employees to get blasted or say they're unethical just for receiving the bonus that they were supposed to get, the compensation for last year's performance, just because their employer is now going under because it is not the employee's fault. So right now it seems like the US government is doing everything it can to contain the contagion, and it seems like this is not going to spread too much because they have acted very swiftly, but we will have to see moving forward. However, this does change one thing, and it's the upcoming rate hikes. At the end of the day, SVB is a perfect example of the issue that federal government or any government around the world that would have to face and juggle when it comes to inflation, a balance sheet, and their interest rate. If you raise rates fast, you can tame inflation better, but you may create unintended consequences like the current potential collapse of the financial system. If you go slow with the rates, you're going to go safer, but inflation is going to be stickier. And in our previous video, whenever we talk about the problem with inflation and raising rates, we have said that rate hikes will not be felt for 6 to 12 months after the rate hikes is implemented. And right now, SVB, it's basically rate hikes from 12 months ago rearing its ugly head and showing us the consequences. And I think this has a huge impact on federal decision next week on whether US wants to continue to raise rates and if they want to raise rates as quickly as they have intended to fight inflation. In fact, right now on CME 2.0, you can see that bond traders are now actually estimating a small chance of no rate hikes for next week and a larger chance of 0.25%. Versus a week or even 2 weeks ago, people were estimating 50 to 70% of a 0.5% and a small percentage of 0.25. No one was even considering not raising rates at all for next week. But after SVB, more people are now hopeful or thinking that the US government may pause on raising their rates. And I think that could make sense as well, because SVB could be just the beginning of these chain collapse of not just the banks, but maybe across many sectors. And while job opening is very strong right now, still seems like we can take more rate hikes. We really haven't felt the full force of the previous hikes yet. So I think it does make sense to take a pause, maybe just see where things are right now before we really overdo it. We go too fast, we break things, and we have now created another 08 on our hand. I think the final piece of information we need to pay attention to would be Tuesday's CPI report, which would probably come out by that time you're watching this. So if the CPI report comes out as expected or better than expected, then I think we can make a real case of a rate pause next week. But if it's much harder than expected, then I think we may still do a 0.25%. For now, with the whole banking fiasco right now, I think a 0.5% rate hike is out of the question. It'll be very risky and aggressive to still do a 0.5%, but we'll see by Tuesday. So that's everything I want to share. This is kind of like an emergency recording. I've recorded another topic on the underused housing tax that I wanted to talk about. But SVB, I thought it was very unique and very important for everyone to understand what happened and what does it mean for us. So that's why I made this video. Now, it is slightly rushed. I have to read a lot of articles before I felt like I know enough just to make a simple video. Let me know in the comment down below if I've said anything incorrect or you think otherwise. Share with me because I really want to hear your perspective as well. If you like these kind of videos, I do upload them 8:30 EST every 2 weeks on Tuesday. So make sure you subscribe to the channel, hit the bell buttons to get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next video. Bye!